gold and silver will be revalued at a faster pace than the ability to unwind the billions of dollars of bearish derivative bets against a higher gold price.
Now, Andrew, you had mentioned a fourth bullish for gold driver, and what feedback are you getting regarding the collapse of the U.S. hedge money?
Yes, Shane, I will do. But before we look at the fourth physical gold accumulation driver, and we've got some very important inputs driving the collapse of US dollar hegemony. So we'll look at that in a minute. First, let's take a look at what I've been working on following our last episode. Now, this is very much a work in progress, but I'm really happy to share this here. And obviously, I'm going to add to this over the next few weeks because this is a major, we'll be looking in the rearview mirror at this. Now, these observations are further to our look in our last market episode 2 weeks ago, where we were assessing the impact of the commoditization of the ruble and what effect that would have on the precious metals market, especially with the oil for energy trade. Now, this week's geopolitical escalations between the US and China and Russia gaining a missile base foothold in Nicaragua seriously ramps up the odds of something going very, very wrong. And there's little doubt that China is militarily able to repatriate Taiwan. And if ever there was a time for China to pull the trigger, to act, it would be while a weakened US is at its most vulnerable, likely before the midterms even, which could ultimately segue a possible road to a more militarily aggressive Republican Trump regime. That's something that would be avoided, I think. So, having seen how quickly money was weaponized against Russia, China is readying. This is information we're getting back from our liquidity providers and people well connected with the Chinese and Russian markets. They're readying for the inevitable widening of these measures and are ramping up current measures to secure monetary sovereignty alongside Russia by formalizing this BRICS currency basket. Now, based upon ongoing discussions with a range of well-connected liquidity providers exposed to the Russian and Chinese markets, we're assessing the likely weighting of the commodities inside this newly determined BRICS basket of currencies. Now, it's a wide basket, but obviously our focus is on gold and silver. And the accelerated deployment of this currency basket, it is so grossly underestimated, we need to look at it. Gold and silver will be revalued at a faster pace than the ability to unwind the billions of dollars of bearish derivative bets against a higher gold price. And at the margin, this threatens the anchor of a 1 quadrillion of derivatives and the collapse of the largest ETF, GLD. Now, there's reasons for that. So just based on our discussions, the likely weighting of the top 3 commodities inside the BRICS basket of gold is gold, oil, and amazingly enough, silver. Because look, while gold is the anchor, the reason the tiny silver market figures so high in the weightings is that it's the most undervalued and short sold of all commodities on the list. And as evidenced by anchor liquidity provider JP Morgan and Standard Chartered exiting the base metal space following the nickel blow up, paper market liquidity supporting decades-old derivative structures will thin out dramatically. And this will feed into silver, which is, again, as we said last time, we have really good information that JP Morgan wants to get their silver back, which according to all estimates, silver is going to proportionally outperform to the upside. Hence, we bring it up into this even though it's a small market, it's the outperformance of its price that brings it into the top, initially into the top of this group. And that being said, Shane, that brings us onto the longer term and more important driver to reset and benchmark the foreign exchange paper gold price against a physically derived global supply demand price. Now, we've looked at this quite a few times over the last 2 years, but if the dollar has any hope of maintaining some semblance of hegemony, gold must be allowed to revalue. And while Basel III NSFRs were implemented to ultimately achieve this revaluation, weaponizing the US dollar has brought this onto the front burner really far, far quicker than they planned. So that brings me on to the final fourth point, which is really long term. We've talked about this before. Gold's collateralization of US foreign obligations is at historic lows, and to protect rapidly diluting US dollar hegemony, this imbalance must be normalized. And the first step and one of the main objectives of implementing Basel III NSFRs was a structured exit plan to address this global imbalance. The unfactored commoditization of the BRICS currency basket has accelerated the process. And we see this as the primary reason gold must in capitals be revalued a lot quicker than was planned. Now, the current ratio of gold to foreign debts outstanding after recent more printing has now shrunk from 6% to under 5%. In fact, I'm generous to call it 5%. The ratio is significantly below the 20 to 40% historical average, which the Bank of International Settlements likely expects the ratio to ultimately revert to into the implementation of Basel III. But as I say, it was supposed to be a slow progress. Restoring a 20 to 40% ratio of gold to foreign debts outstanding from current levels easily puts gold at between 6 and 12,000 per ounce. However, the last time the dollar was questioned in 1980, which is clearly the case now by the BRICS countries, okay, not globally, but by the BRICS countries, then foreign held treasuries of the US government at that point back in 1980 ramped up to 140% of collateralized by gold, technically valuing gold at 40,000 per ounce. Now, I'm not saying that's going to happen. The migration of the oil trade and the recent Russia-China alliance, which accelerated the commoditization of the ruble and the yuan, poses an unfactored threat to unbacked US dollar hegemony.